Welcome to the program. Well, I think it's fair to say that most investors, brokers and analysts will be glad to see the back of 2011. It was a year that was marked with volatility across all asset classes and seemingly racked from one crisis after the next. Concerns about falling commodity prices and concerns about slowdown in China's economic growth helped to push the ASX 200, I should say, lower, with the benchmark now closing down about 14% or so for the year. Well, that's the way it looks like it's going to finish up. But it's not all doom and gloom. There were a few diamonds in the rough. I'd like to open tonight by asking our expert panel about some of their hits and, I guess in the interest of balanced broadcasting, some of their misses. Carl, I was talking before and you were telling me that you educate mums and dad investors about the stock market and the equity market. Are there any particular sectors that you think have outperformed? Obviously, retail's been taking a hit in the last couple of months. Commodities seem to be under a bit of pressure. What are some of the, I guess, in terms of relative value, the better sectors to be invested in at this point in time?
Yeah, sure. Look, it's been a difficult year for most sectors in the market. And in fact, no surprise that the worst performing sector in 2011 was the consumer durables and apparel sector, and that was down some 64%. And you didn't have to be Einstein to work out that was going to be the worst one. Followed closely by retailing, down about 40%, and then resources, which has probably taken a big whack out of a lot of mums and dads' super portfolios this year, down 32%. So they were the ones to avoid in 2011, and really, when you're looking at, I'm more of a technical analyst, Mark, so when you're looking at the technical picture for all of those sectors, if you do have stocks in those sectors, the trends are all still very much down on a short-term, medium-term and long-term basis. And I look at all three time frames to determine what investors of different styles are doing. So I say in the market, look, you've got short-term traders looking for quick swings, medium-term traders trading over a few months, and long-term traders trading over a few years. When they're all doing the same thing, when they're all stampeding for the door, that's when you're going to get the best trends. And the trends certainly in all of those sectors are still down. And for me, I think you want to be out and stay out of all those sectors. The best performing sectors for 2011, clearly the telecommunications sector, and of course the star there is it's really the Telstra index, isn't it? So no surprise that did quite well with Telstra powering that one higher, but up about 18% versus the market's down 14%, followed there by the utilities. And the number of stars in that sector fairly narrow. Investor being probably the standout there, E&V, and for me that one still looks really good for next year. And then third on the hits there for 2011 was the food and beverage and tobacco. Look, a pretty narrow list on the upside. Only 3 or 4 of those sectors showing positive gains for the year, and not surprising either. The trends in all of those sectors still look good, and I'd be happy to continue to target the key stocks, the bigger stocks and the high yielding stocks, I think, for 2012 in those sectors for next year.
Okay, I might tap you guys with some forecasts later in the show, but we've got our first call on the line, and it's Brett from Sydney. Brett, are you there?
Yes, I am, yes. My question's regarding Data 3.
Data 3?
I'm having a look today. Its share price is very low, actually. It pays a very good dividend. It's a very good company. I'm just wondering, both guys' opinions are, A, is it a good time to buy now, or wait till later?
Sure. What sort of dividend are they paying at the moment, Brett?
Roughly franked, it works out to be about 7.2% on today's price.
Oh, that's not a bad return, given the returns on other asset classes at the moment. Looking at that chart there, Carl, looks like it's been, well, not so much one way, but pretty choppy downward trading. What do you see from that?
Yeah, look, again, just focusing on those three trends. So thinking about what each of those three key time frames, the short term, the medium term, the long term investors, and for me, it's pretty clear that investors of all time frames are trying to exit this stock, and there's not a lot of demand out there for the stock to soak up that supply and cause the price to go any way but down. So it looks pretty bearish from me. If you're in the stock and you're looking for a place to use as a stop loss, I think about $1.05 is the key level there. If the price moves below $1.05, then I think that's kind of that last level of support, and the price can fall away quite quickly. So I think that's the key level if you're in the stock. If you're not in the stock, then it's not a stock that I'd want to be putting my money on just at this point in time. In fact, my systems, which I teach at my workshops, signalled a short sale on this only about 4 days ago. So it's getting ready, I would say, just upon that for quite a sharp move down. So be careful.
All right, thank you. Our next question comes via email, and Paul asks, BC Iron in production is making the big bucks. What do you think its market cap is? Why do you think its market cap is low compared to other iron ore miners in production? Good question. Once again, sideways downward trading. Any idea why it's not being bought up at the moment?
Just from a technical perspective there, Mark, look, well, firstly, the question was about why the market capitalisation of this stock isn't perhaps as strong as some of the other stocks, and that can depend on a myriad of factors in terms of their production, their costs, and there's just too many factors to be able to answer that question with any authority. Look, I can comment on the technical side of things, and remember that technical analysis is just the study of what supply and demand is doing at any point in time. When there's more supply than there is demand, the price is going to be going down, and I guess as a technical analyst, you always defer to the basic tenets of economics, which is the people supplying are doing it for good reason. And if there is more supply than demand, then stay away from the stock. And that certainly looks to be the case on this one. A clear downtrend on all of those three key timeframes I look at. I can't see one reason from a technical perspective to have my hard-earned money in this stock right now.
Sure. That chart we just saw a little while ago showed like it sort of bottomed out, had 4 bottoms. Is that going to be a big support level around that sort of 2 to 210 level, do you think? Yeah,
look, we can certainly talk about support levels here, and there's a significant amount of support around about that 210 level. It's not looking as bad as some of the resource stocks at this point in time, and certainly some of those iron ore miners which have been beaten up pretty badly. If you're in the stock, look, 210 is clearly a place to put a stop loss behind, and I'm a firm advocate for having stop losses on everything that you're invested in. It just gives you an unemotional place to exit the stock. If you are in the stock, then, as I said, stops below 210. Look, if it can get itself above 270, then I think there's some hope for the stock, but there's so much overhead resistance on this one, I just can't see it moving away very quickly from here, even if it does break that key 270 level.
All right. Our next question comes from Abe in Sydney. Abe, are you there?
Yes, thank you for taking my call. I've heard Carl before saying that you should keep away from materials this year. You think so, I guess, such as Rio and BHP. And the question is, if you've got them and you bought them at high prices, do you sell out and get out and buy Telstra shares, or do you keep them?
That's a very good question. Do you switch from materials to another sector? Carl, you've already put the kibosh on the sector itself.
Yeah.
Is now the time to look to get out of some of these big material players and start looking at other sectors?
Yeah, look, absolutely. I don't think it's ever too late to get out of a losing trade, and you know, the oldest saying in trading and investing is to cut your losses and let your profits run. And if you're holding on to BHP and Rio right now, and you've been holding on from higher levels, I think you're doing the exact opposite of that, and you're letting your losses run potentially. Look, I'm all for putting my money at work in the place where it's going to earn the greatest return. And the way I look at returns is it can't just be dividends and it can't just be capital gains. It needs to be a solid mix of the two. And looking at the material sector in general, and then drilling down to some of those big stocks like your BHP, your Rios, your Fortescues, your Oz Minerals, they are all in significant technical downtrends. And again, you have to ask yourself, with all of in theory, all of these great fundamentals into the future, why is it that investors en masse continue to not want to hold these shares, and in fact turn their investment in these shares into cash, where I guess they feel that they're going to get a better return? I don't think it's ever too late to get out of a losing investment. I think if you were to make the switch right now from a BHP or Rio into a Telstra, I think in 6 months' time you will reap the rewards of that decision. Anything longer out than that then is probably way past my own time horizons.
All right.
Sorry, just on that, Mark, question about commodities and commodities prices. If you look at the UBS commodity index, which is a major index of commodities, it's about to make a significant technical breakdown, and if it does get below the level there is about 135 on that index, and if it does get below that, then there's probably another 20 to 25% that it can go down. And the other broad commodity-based indexes like the CRB and the Industrial Metals Index all look just as bad as each other, and I think that's the market telling you that things can get a whole lot worse for the likes of BHP and Rio, and I would not be surprised to see a 2 in front of BHP and you know, a 4 and a 5 in front of Rio before year's end in 2012.
We're talking about commodity prices, and now we're also, I guess, shying away from the materials sector. All the experts, at least there anyway, saying that, you know, approach there with caution. A lot of this has got to do, of course, with the concern about economic growth in China, and sure enough, we have seen some slowdown, but that was what I guess the Chinese government was trying to orchestrate, to try and, I guess, take some heat out of the system. Carl, what about yourself? What's your view on China at the moment? Are you concerned about it? Do you think that, that this demand we see at the moment will sustain at present levels? Do you think it will increase, or do you think it will look at a bit of a pullback?
Yeah, no other government in the history of mankind has ever orchestrated such a period of growth and not had at least some sort of bust coming after that. We can go back and look at booms like, bubbles like the Nasdaq bubble in 2000. You go back to the bubble in the Nikkei in the early 1990s, which was also coincidentally a property-based bubble. We can talk about the subprime crisis in the US, and they always say, cheap money is forever blowing bubbles, is the old saying, and there's certainly been a lot of cheap money sloshing around China, both regulated and on the shadow side as well, very recently. And I think, look, the problem for China is that in 2011 they didn't see Europe coming. So they were going through a process of tightening up reserve ratios for banks and trying to, as you say, restrict credit, and then it kind of feels almost out of the blue Europe happened. Everybody was focused on what was happening in the US, and then Europe just blew up on everybody. And that, I think, has put them in a really difficult situation, because they're at a point now where they actually probably need to keep credit quite loose to keep the economy rolling along, but they also need to control some speculative areas of the economy. So I think it's going to make it really tough for them in 2012. And I think they are the big bogeyman for the markets in 2012. I think the market understands Europe now, and I think whilst we're not happy with it, I think we kind of get it, and I think it's in the market, it's in investors' minds, and I don't think China's quite at the forefront of investors' minds. And I think 2012, China will be the big story. I think you'll have the US improving. I think that's already happening. And Europe's known, and it may get better, it may get worse, but at least we know about it. I think the big bogeyman is going to be China, and I think that means a lot more for Australia. I think it means a lot more for Australian mining companies, certainly, than Europe did. I remain bearish on all of those big resource stocks for that reason. I am, however, and this is going to sound a little bit contradictory, I am long-term a real believer in the China story. In fact, all of those BRICS economies. But it would not surprise me, and I think it's quite logical, and it makes total sense for them to have a period of a year, of 2 years, or 3 years, where they have a little bit of a stumble, a little bit of a road bump, and try and sort that out. And then 3, 5, 10 years from now, we will see Rio Tinto at $150 or $200 a share again, but it may well be at $30 a share again in the short term before it can do that. But I'm not sure how many investors out there have factored that in yet.
Yeah, that's a very good point that you make, that it's gone too far too soon. We might see a bit of a pullback, but generally speaking, I think you're right that going forward, you've got to expect that China's still going to become more urbanised, so to speak. Yeah. Our next caller is Javal from Melbourne. Javal, are you there?
Yes, I'm there, thanks.
Have you got a question, Javal?
Yeah, I was just thinking, I was looking at a couple of speculative for 2012, and I fell across WHN, so I just wanted to know what the panel thinks about this stock.
Certainly, WHN. Carl, looking at that chart, that's a little bit more positive than the other charts we've seen so far tonight. It has come off its highs. Once again, probably on concerns about the outlook for energy and also resources. What do you read from that?
Yeah, look, I must admit, Mark, I don't know anything about the stocks. I can only comment purely on what I see here on the technicals. It's certainly not the worst one I've seen recently, but looking at this, I can see a definite shift there from a well-defined technical uptrend now really to the uptrend faltering, and it is on the verge of turning into a technical downtrend. For that reason, it's not something I could possibly put my money on. I'm a very strict rules follower there, and it can only be in an uptrend for me to go long, and only in a downtrend for me to go short. So it would preclude me from being able to hold this stock. I think if you're in it and you're looking for a speculative play, I think there are better stocks out there than this one, purely from a technical perspective. And I could probably reel off two or three a little bit later on if you'd like me to. But for now, I would really avoid this one.
OK, so one to avoid. One for the specky bucket. Very specky bucket, that is. Our next question comes via email. And Ian asks, what can you tell me about deep yellow shares? Deep yellow shares. Uranium miner, would that be right? Yes. Carl, any thoughts on deep yellow apart from their deep dive on the share price there?
Yeah, look, I can tell you with a great deal of certainty that there isn't exactly a stampede to own these shares. And that could well be because people have forgotten about the story. Of course, I mean, this was a star stock only a couple of years ago when uranium was all the rage. And look, they've either forgotten about the story or they're just they know the story and they're just not interested in it anymore. I want to be in stocks that people know about, understand and are investing in. The volumes will tell you that that's occurring. There's really not a lot of volume or trading on this one. It's a 13.5 cent stock, and look, I think, you know, I don't know where your callers from there, Gold Coast. So Gold Coast has got a pretty good casino out there at the Treasury, and I think you're probably better off going down there and having a bit of a punt instead of trading in deep yellow.
Carl, what do you think about uranium at the moment? Is it I mean, I know you're against materials, but is uranium one to avoid as well? Yeah, look, it falls straight into that category of those materials and resources stocks, and the biggest one, of course, is Paladin, and or Paladin ERA. I mean, they all look just as bad as each other, and again, I just think there's so many other better opportunities out there right now to put your money in than to really do nothing but gamble in these and hope for a turnaround. I just can't see the point of that. We have another call on the line, and it is Shane from the Gold Coast. Shane, are you there?
Yeah. Listen, I was listening to your comments earlier on about the American economies gradually getting better. Europe's a basket case, and so be it with China. I was wondering, would now be a good time to go into QBE?
Has been a bad performer this year, but has been beset with a whole lot of natural disasters. Is there sunshine ahead for QBE? Who'd like to kick us off? Carl?
Sure. Look, I don't think so, unfortunately. QBE has been one of my personal best performers this year, but only because I've been short it, Mark. So nothing really has changed for me on QBE for the last 6 months or so. It's in a clear, well-defined downtrend, so I'm sure there are good fundamentals and for the stock, and we're about to hear about them, but there's got to be a reason why people, short-term traders, medium-term traders and long-term traders are all selling this stock, enough so that the demand cannot soak up those shares. Look, I'm all for buying fundamentally sound and strong companies, but when the market and the rest of the world agrees with my view and is therefore on the same side of the market as me, if you're in this stock, if you're holding this stock, then I think really I'd almost go so far as to say that now is the time to get out of this. If you are a shorter term trader, if you're a CFD trader and you trade both sides of the market, both long and short, well, my system, the one that I teach at my workshop, fired off a short sale on QBE about 5 sessions ago. So if you're looking to trade this one, then certainly look to take shorts around the current levels. I think you can put stop losses around about 1460 to 1465, and really the targets are quite open-ended here, and really this could fall back into high single digits, I think. So I guess a little bit there for the longer term holders and the shorter term traders as well.
All right, now to an email, and Pierre writes, the panel give me their opinion on Hastings High Yield Fund. It has a yield of 13%, pays a quarterly dividend, has an asset bucket of 1.48 cash, on hand 45 million. Should I buy it for yield? Hastings High Yield Fund. Should you buy it for yield? Carl, on that chart, would you buy it for yield? No, based upon the chart, absolutely not. Again, I'm all for buying solid stocks on a fundamental basis with a great dividend yield, but the market needs to agree that their growth prospects are there, and I can't see the market really rating this one that highly from a growth perspective. If they were, then you'd see the share price in a significant uptrend, and it's just not there. I think there are so many other things you could do better with your money. First thing is probably just put it in a term deposit. If you're thinking about buying this one, I think you'll have a better result. Alternatively, if you're looking for more of your sort of blue chip stocks that actually do have a reasonable yield, there are a bunch of them out there, and my high yielding blue chip stocks that are actually in an uptrend as opposed to a free falling downtrend like so many of those blue chips at the moment. I think keep an eye on stocks like GrainCorp, InvoCare, which I think is an absolute superstar, IINet in the technology space, the telecoms again. I think Monadelphous, which Mark mentioned before, is also highly prospective and in terms of a capital growth perspective, and also paying a really good yield, about 4.75%, fully franked on that one.
I think Program Maintenance Group looks pretty good as well, with about a 4% yield fully franked. And if you want yield, and I know that Hastings fund was about 13%, but if you want yield, I don't think you can go past Telstra at about 8.5% fully franked. And I think that we could see a 4, and I think we will see a 4 in front of the Telstra share price sometime in the first 6 months of 2012.
Okay. Next caller is Jenny from Townsville. Jenny, are you there?
Yes, I'm here.
Do you have a question, please?
Yes, the question is, I just needed some information on the share BTT.
BTT?
Yeah.
Are you looking to invest in that particular stock?
Yes.
Okay, BT Invest.
To the fund, I think.
What do you think, Carl?
Look, I think the same response as the last one, Mark. I can't see any reason why you would want to hold this. I think the market's telling you, just looking at that chart, that the prospects aren't that great into the next 12 to 18 months. And as I said, same response as before. I think there are better stocks out there that you could be investing your money in.
Our next caller is Jack from Brisbane. Jack, are you there?
Yeah, mate.
You got a question there, Jack?
Panel, best of the seasons to all of you.
I'm sorry, mate?
I said the best of the seasons to you, for Christmas and all that.
Thank you very much. Happy New Year to you as well.
My question for the panel tonight is that Queensland National Rail have paid out all their loyalty shares, and I'm wondering if the panel thinks that they could possibly pay a dividend of around about 10 cents per share, because their first dividend was peanuts.
So you're looking for an increase in the dividend for QR National?
Yeah, I just think, do the panel think that there's a possibility that Queensland National would go up as high as 10 cents dividend per share?
Sure. I don't know what the backlash from the investors was last time round. Carl, does it come across your radar screen at all? Is that one to buy, one to avoid, one to sell?
Yeah, look, I can't really comment on the dividend perspective, and who knows what management are thinking. And I have to go back to the caller I say and just ask him whether he was talking about 10 cents for the full year or 10 cents for the half year. But 10 cents for the full year is possible, but for the next half is probably unlikely, just from a purely technical perspective. However, look, this one actually looks pretty good. Short-term, medium-term, long-term trends are still up, not lighting the world on fire. However, the key level is clearly that 360, which is the all-time high in very short history on the stock. I think if it can break 360 and with some significant volume, which would indicate that all of that sort of deadwood supply, all the people that have been thinking 360 was the ceiling for this one, if you can get them out of the market and get them back into cash, as the stock moves above and beyond 360, a lot of those people who now are sitting on cash are going to look back at QRN and think that they'd actually rather be back in the stock, and that can certainly fuel a bit of extra demand into the future and see it move from that 360 certainly up to fours or early fours very quickly. So 360 is the key level there for a breakout, for a long trade into the stock. If you're in the stock at this point in time, then I think you want to be having your stops set around about that 320 level. If the price breaks below 320, then it will probably move back to $3 after that.
All right. Our next question comes from Eric in Sydney. Eric, are you there?
Yes, thanks, Mark, for taking my call. I was watching Switzer last night. This is just a side to my question. And about 15 callers emailing in, with self-managed super funds, and they were all going to sell shares and go into property. So, I mean, that tells you what the sheep are doing. The question is on ARB. Carl, is it possible to get a chart up from late 2008 into March of 2009? I bought ARB at 285. I dare say if you saw the chart, you'd be telling me not to buy the stock, but Warren Buffett would be buying the stock at 285, and I had an intrinsic valuation then of around $4.50. Just some questions on that. Thanks, mate.
Okay, is it possible to get that chart going back to 2008? Can we get that going back any further? We're just while we're waiting for that chart to come up. Carl, your first thoughts?
Yeah, look, I've got the chart here, and is it Eric? Yeah, Eric's quite correct. If you go back to probably about March 2009, all of my systems would certainly have been saying stay away from the stock at all costs. The first buy signal that was thrown up by my trading system was thrown up here. I'll just give me 1 second and I'll zoom in. So the first buy signal was thrown up on the 6th of July 2009, and that would have got you in around about 352 on the stock. So I think, you know, it certainly wasn't the low. The low of the stock was around about 230. So if you look at that, if you're a technical trader waiting for the market to come around to the way of thinking that ARP is recovering and that the earnings are going to grow and it's a good stock to be in, you would have given up about 30%, no, more than that, about 50% on this trade. So instead of getting at the exact low at 230, you would have got in at 350. I think with the share price now around about $8 and up to 850, I don't think you'd be too fussed whether you got it at 230 or 350. I think the great advantage of getting at 350 is that you're getting in with some confidence and some confirmation that the supply and demand fundamentals have changed around and people are starting to really like this stock. I think if you bought it at 230, then absolutely you're a superstar, but you probably also tried to pick the bottom at 240, 250, 260 and all the way down as well. So look, I'm not one to try and pick the bottom. There's an old saying about people who try and pick bottoms in the markets. Look, I want to get into a stock when the market is starting to agree with me about the way it's going to trade, and then I'm happy to hold it while it's going up. I think, you know, whilst it's going up, stay with it, and as soon as it starts to come back, you know, have a stop loss somewhere and get out of it. And I always say you don't have to love your stocks. They're not like your family. You're stuck with your family, but you're not stuck with your stocks. And, you know, have an exit point in mind somewhere along the line. Have a trailing stop and move that up, and you can have the best of both worlds. You can have the rise in the price, and then you can be out when it comes tumbling back down again.
All right, and you can see that chart going back now to 2008 on the screen. Obviously, it's been a good ride for Eric for most of that time. Okay, we've got time for one more quick one, and it's via email, where Kim asks, what do the panel think of Thorn Group? They seem to be in a good space with rental appliances in the current economic climate. And that's it. What do we think? Carl?
It's actually a very similar chart to the last one we looked at with ARB Corporation. Has had a tremendous run through 2009, 2010, 2011, peaked out very early this year, and since then there's been only a gradual but steady decline. It's switched over to a technical downtrend now, which precludes me from being able to put any of my money on it or recommend any of my clients put their money in it. And for that reason, look, I'd say if you weren't in the stock, then I'd strongly suggest that you stay out of it. If you are in the stock, then as I said, that because we're not all Warren Buffett, we don't have $60-odd billion to not have to worry about losing and holding on to stocks for years and years. So if you're not Warren Buffett, then I'd suggest don't try and trade like Warren Buffett and use what we call is a stop loss. And there's nothing wrong with getting stopped out of a position. The great thing about getting stopped out of something is you get all your cash back. Then you can go and find something better to do with that money. So if you are in the stock, then I think a stop loss at just under 150 is a good thing to have here. It's going to protect your capital. It's going to deliver the vast majority of your capital back, and you can put it at work in the market somewhere else.
That's all we have time for today. Thanks so much to our guests, Mark Morland from Team Invest and Carl Capolingua from Australian Stock Report. And to our viewers, for all of your calls and emails, see you again in 2012. Happy New Year and good luck.